Gold has traditionally been a safe haven asset and a hedge against uncertain economic times. In recent years, gold prices have risen significantly from around $1,200 per troy ounce in September 2018 to above $2,900 per troy ounce in February of 2025. In an environment of uncertainty surrounding the global economy, the geopolitical tensions in the Middle East, and the Ukraine-Russia war, gold has gained tremendous interest for investors looking to diversify their portfolios and capitalize on the volatility of global markets. Traditionally, you could purchase physical gold in the form of gold bars and coins from local banks and dealers, providing direct ownership of the physical asset. Several Malaysian banks also offer gold savings accounts, where you can buy, sell, and store gold electronically without physically holding it. These accounts are typically denominated in grams of gold and are a convenient way to gain exposure to gold prices. Investing in gold ETFs, exchange-traded funds, or unit trusts that focus on gold or precious metals is another method of gaining exposure to the precious metal. All the above methods traditionally do not utilize a powerful tool called leverage in trading and investing. Gold futures offer an exciting opportunity to maximize capital through leverage. While some ETFs and specialized unit trusts also use leverage, it is usually much lower than what gold futures offer. Let's explore how to maximize your capital through gold futures trading. What are gold futures? A gold futures contract is an agreement to buy or sell a specified amount of gold at a predetermined price and date in the future. These contracts are traded on exchanges globally, such as the Chicago Mercantile Exchange, CME, COMEX Gold Futures Contract in the United States, one of the most active gold futures contracts, and is the benchmark for gold prices worldwide. Each gold futures contract represents a specific amount of gold, say 100 troy ounces, and its price fluctuates based on global supply and demand, economic data, geopolitical events, and currency strength, particularly the US dollar. Bursa Malaysia Derivatives, BMD, also offers a gold futures contract using the contract code FGLD. FGLD is a US dollar denominated and Ringgit Malaysia settled gold futures contract traded on BMD, designed to provide market participants with exposure to international gold price movements. Why trading gold futures maximizes capital? Trading gold futures offers several advantages over other forms of gold investment, primarily due to the leverage factor, controlling a large amount of gold with a relatively small investment, allowing you to amplify your potential returns. For example, you buy a 100 troy ounce contract with COMEX Gold Futures at the price of $2,500 per troy ounce, equivalent to holding gold position exposure of $250,000. The exchange's margin deposit is only around $10,000 to hold this position. That represents a 25 times leverage. If the price of gold increases by 1%, the buyer of the futures contract would see a gain of $2,500 or 25% gain on the margin deposited. Every percentage point gain in the gold price would translate into a 25 percentage point gain on the margin deposit. In the case of the BMD FGLD contract, each dollar move in the gold price per troy ounce is equivalent to 40 ringgit, as the contract multiplier is 40 times the reference price of gold per troy ounce. Suppose gold moved by 1% or $25, as in the example above. Then a buyer of FGLD gold futures will gain 1,000 ringgit, 40 times 25, while the margin deposit to hold a contract with FGLD is around 2,800 ringgit. A small 1% move in gold price translates to a hefty 35.7% gain on the margin deposit of FGLD. However, with leverage comes risk, and understanding how to manage this risk is critical. Leverage can work both ways. It can multiply your profits and magnify your losses. To maximize your capital, always use leverage wisely. A good rule of thumb is to trade with only a tiny portion of your capital at risk while keeping the rest as a reserve. Implementing risk management strategies like stop-loss orders and position sizing are crucial to protect your capital. Using leverage conservatively minimizes the risk of running down your account if the market moves against you. Gold futures trading offers an excellent way for investors to grow their capital if approached with caution and discipline. Beginner traders can take advantage of gold futures opportunities by starting small, using leverage wisely, and implementing robust risk management strategies. Get bullish about learning.